Ladies and gentlemen, welcome to the SoFi Weekly on a Monday morning, joined by a bunch of special guests. Thank you to Danny, Chris, Tevis. Who can forget Roy? Thank you, Roy, for being here. Everyone, say hi to Roy.
Thank you to Danny, Chris, Tevis. Who can forget Roy? Thank you, Roy, for being here.
Good morning.
Say hi to Roy.
I think it's Danny.
Tevis.
Danny, mute.
Who can forget Roy?
Hey guys, I think that's my echo. Sorry, I closed my browser.
Okay.
I'm technically horrible. Apologies.
But let's go through some of these earnings, cover some numbers, and then get into the earnings call at 8 o'clock. All right. Let's do this. So, do we want to just cover all this stuff, or do we want to just jump right here and go back?
You decide.
Anyone?
You're running the show.
Yeah, let's just start top to bottom.
Let's go. Members. Okay. Members came in a little higher than Q2 of 2023 at 585,000. Much less than the 717,000, but management definitely said for us not to keep our expectations as high as what they were previously. Chris, what do you have to say about this?
Yeah, I'm not that surprised. I mean, I think we knew that they were going to pull back a little bit on marketing, kind of like this was lower than I thought they'd be just because Q4 is usually so good. But remember when Q2 came out and that 584 number blew us all out of the water. Like this is slightly better than that. Now the Q3 number was obviously awesome. But I'm not that surprised, honestly, and it doesn't concern me that much.
Yeah.
I would have hoped it had a 6 handle, but at the end of the day, I think that, we had 2 theses last Friday, and one of them was like, okay, well, my whole thought process was Q4 is always the highest and that trend will continue, or even if it's not going to be like the highest this year, it's still going to be on the higher end. And then the other side of the argument was they're going to do everything that they possibly can to make sure that EPS number comes in line. And so it was almost like a seesaw in terms of, do we make sure that we crank up that EPS number as much as possible or keep members high? And I mean, 585 is still very good. I think that for a lot of our expectations, we're definitely on the more bullish side, adding a higher premium to the amount of sandbagging that management does. So don't take it as the numbers, if we said 650 on Friday and they came in at 585, that's not bad. That's still fantastic.
Right.
Yeah, it's roughly what I was. Oh, sorry.
Sorry, go ahead, Roy.
It's roughly what I was expecting. A little bit slightly lower, but yeah, they're gaining for that, going for that EPS, and really, it's more what they're guiding for. I saw a headline. I haven't seen it yet in the presentation, but there's a lot of slides to go through. That they were, I believe, it was 2.3 million new members that they were guiding for in 2024, which the baseline was 500,000. So that's a nice increase. So that's forward looking. That's more what I'm interested in. So really good.
Danny?
For me, I wish we could get away from this metric of just member ads because I don't think that really makes money for the company.
Sure.
And just get to more of the financials because it's kind of a red herring, I think. But I'm a SoFi mega perma bull, and obviously I like the top line. I like the profitability. The first thing that jumps out at me is the cross-selling is a little bit weak. I mean, I would have liked to see more products. I'm generally, I think it's very SoFi report. It's very steady, very expected, just very, very controlled. Obviously, less than my idiotic predictions, but still, I think very, very good. I think management, that's why I don't manage a major corporation, because they're steady, sober, and exemplary management. So I'm very happy as a shareholder with the ER at first glance.
Yeah. Let's move on quickly, but I did just want to mention there's something a little bit different about this earnings than previous. If you actually look at the cross sell, in my opinion, it holds very steady. I think it is above 1.5. It's not actually, if you look at it, it's like 1.477. But they changed something in their investment numbers. So I'm going to skip along here. really quick, and then we'll get into the tech platform. The invest numbers for their, brokerage side of the business was at 2.381 million, or sorry, 2.381 million accounts. Last quarter, it was, bear with me.
That's what it is. So there's a note on those products. It says year-over-year growth in products was 45% when we adjusted to exclude the accounts of our now closed digital assets business. So they adjusted the products down because of people who invested in crypto with them and have left.
Good catch.
Yeah. So it was like 80-something thousand people that left, including all the new people that came this quarter. So it was probably like 2 or so 100,000 that were not accounted for, that, we didn't get to see that growth. So I actually think that the cross-sell was probably fine. They just wrote off a lot of accounts, which hurt the product.
I think you're right.
Going up really quickly, if we look at Galileo accounts, we saw an 11% year-over-year increase to 145 million. To be more specific than that, we saw
7, I think.
8.68 million new accounts quarter over quarter, an increase of 6% quarter over quarter. Tevis, what did you think, my friend?
I want to hear them talk about the specifics on the earnings call about, what they've been seeing about Galileo accounts. I mean, again, I think the major catalyst here that we've been looking at for the past 2 or 3 quarters at the very least has been in Q2 of 2023. They came out and they said, hey, we're making some changes. We're going to have higher expenses for a little while. We're moving to on-prem, and we're going to be chasing higher deal sizes, which have a longer lead time. And since that time in Q2 until now, we have been waiting anxiously to find out how far along they are in their pilot program validations. And so, the numbers, look at the numbers, right? They used to be going up double digits. They used to be going up triple digits before, and now they're going up, 10%, 11%, 15%, whatever. Once those pilot programs get validated and these legacy financial institutions start to move the bulk of their existing accounts onto SoFi, because remember, during the pilot program validation, it's only new accounts that move onto SoFi. So it's like very incremental. Once that gets validated, you're going to see massive blocks of accounts being moved over. And that's when the party is really going to start. And so for me, the more important part, and of course, I expected this to be more bullish. I thought they were going to add like 5 more million accounts, but I still am really bullish on the Galileo account, because once that gets validated, and this is why I'm going to be listening to management on the earnings call to see if they're going to talk about it, because once that gets validated, we're going to see huge blocks moving over.
Right. Anyone else want to talk about the Galileo before we move on?
Yeah, it's just going to be lumpy, I think. 11% is fine. With bigger accounts, you'll see a bigger swing.
Sure.
The other thing
I don't think we need to hear from anyone else. Roy said it, I'm just kidding. Go ahead, Chris.
No, I was just going to say, this doesn't really include Technisys, right? So
yeah,
I guess I've kind of not focused quite as much on the Galileo account numbers because it doesn't tell the whole story for the tech platform.
And if you look on the just taking their revenue and dividing it by the amount of money that they're actually bringing in on a per account basis, it actually went up quarter over quarter. Not by much. I think it was like 66 cents to 67 cents. But it could show that either people are spending more on the platform, or, maybe Technisys is playing a role in that as well. Okay, so lending went up 24% year over year, and financial service products went up 45% per year. Holding up this growth rate on lending has been extremely strong for the last about year and a bit. So that's pretty incredible. Financial services, once again, still holding up a great growth rate, but obviously this does account for a little bit of shift in their invest products, which actually came down this quarter.
Can we actually pause here and flip over to the actual report that shows originations and shows the actual lending breakdowns, Tanner?
Yep. Yeah. I was just going through all the product things before we get into the, let me see if I can get it here. I have it here.
Roy, is that okay if we do that?
You have my permission.
Do you give us permission, Roy?
Good. Thank you. Is that big enough?
Yeah, that's good. Yeah, originations are down in both personal loans and student loans, which I did not expect.
Yeah.
Like I expected personal loans to be down, but not that much. I didn't expect student loans to be down. I expected them to be up quarter over quarter. So that was surprising to me.
Yeah. So a little bit more of a breakdown, because this doesn't, at least I don't think it doesn't show you quarter over quarter. Last quarter for personal loans was 3.8 billion. So we're seeing 3.2 billion. And then on home loans, we saw 355 million. We're seeing 308 million. And then 919 million in originations for student loans. Very surprisingly, under 800, 789. So
Yeah, that one, it's even actually a little bit softer than I thought. But we talked about it on Friday. But there's two types of students. There's the ones that are like really early, and we saw those hit last quarter as far as the refinance repayment. And then there's those that'll do it absolutely last minute when the penalties actually start getting real and significant. So, and then with holiday spend, you had that as another factor. So for me, it's not particularly shocking here. I think that we're going to see that rebound somewhat in quarter one, but really as those penalties start hitting back in. But Bears may key off of this. I don't know.
Danny, anything on this?
I just feel like whether it's this past quarter or 2024, the student loan business has to come. SoFi just owns that market, and as those rates come down, so just for me as a long-term person who's just going to hold, I think the student loan business is going to be great, but the Fed is obviously kind of toying with everyone, and they keep talking forgiveness, and everything is still in flux. So as much as SoFi wanted certainty on the student loan issue, we really still don't have certainty. There's forgiveness every week. So I think this is just going to be a great business for SoFi, but it just hasn't picked up steam yet. So I would have liked to see more, of course, always, but I still think that's SoFi is going to own 60% of that business plus over the long term, and it's going to be good for us.
Well, the interesting thing, the thing that sort of surprised me a little bit was in their guidance for 2024, they expect lending to be down, 92 to 95%, I think, if I remember correctly, of the 2023 lending number. So it's probably going to be a decline in personal loans that's going to bring that down, and student loans are going to keep steadily climbing throughout the year. But I found that to be interesting, right? Because we sort of have talked about in the past, how are they going to get to this 50-50 revenue split? And if lending is flat or even slightly down, I mean, I don't think it'll be down because this is the first guidance that they're going to sort of sandbag, and then they're going to raise. So I think it might end up being flat instead of down, but that is interesting just to see in perspective with how this Q4 origination numbers came in.
I think the important part there is that we need to see what they're guiding for in the macro to understand what they're seeing on the lending side. And so if they're continuously being extremely conservative, then that might not be what actually comes to fruition. And so this is the same thing with the 50-50 split between lending and financial services and tech platform. I'm assuming, and we'll hear it on the call, is what are they guiding for in terms of rate cuts? Because the more rate cuts, the faster they're going to be able to turn their book. And that lending side of the business won't be at 92%. I actually think as the quarters go on and we realize more and more of what SoFi is able to do, we're going to see a very similar 2023 of the guidance in Q1 is nothing like the guidance from Q4. As we shift along, it's going to get constant improvements. So let me quickly bring up this because I don't want to get too far ahead with guidance and stuff like that. We got a lot to cover, but let's talk about the real fun here. Okay. On the adjusted net revenue side, we saw an increase of 34% year over year to $594 million. And quarterly adjusted EBITDA nearly doubled to $181 million, putting an EBITDA margin at 30%.
Yeah, insane.
30%. So I said, if Chris is going to get what he wants out of EPS, it's going to need to be like above a 25% EBITDA margin. And it blew past that. Chris, what are your first thoughts?
So this number is huge. And actually, so I'm still trying to figure out, we'll get to this later on. This number actually corresponds to about an EPS of 5. There's some like $20 million of adjustments later on, and I don't know what those are coming from yet. I'm still trying to figure it out. But these numbers, so both the revenue and the adjusted EBITDA numbers are really, really high. Like they blew it out of the water with what they did inside of Q4. Like, I mean, just look at the chart, right? Like you're seeing an acceleration of revenue growth on the left, and then just an explosion in the EBITDA growth on the right.
But like, so,
and they, go ahead,
Chris. I guess a question on that. Like, I guess what surprised me more is the degree to which they can control this bottom line number. I mean, it's steady growth, and then they come in more than double, or double what they were in previous quarters. That, I guess, initially shocked me a little bit because it just shows, wow, they have a lot of levers in their control that they can pull to really manipulate those bottom line numbers and get them to where they want them to be. I remember on the show when we were talking about the forecast, we were saying, wait a minute, they have to hit a 26% EBITDA margin to even hit their estimates. And we were saying, oh, wow, like that, we don't know if they're going to do that or not. And then they come in at 30. And that's just insane to me.
Yeah, it's mind-blowing hitting over. Sorry, go ahead, Danny.
They just stopped spending. I mean, they can dial these numbers into the penny. He's had this ER dialed up for a year. I mean, Noto's playing this. He's going to pump this thing to 45 like a virtuoso. I mean, I know we're ahead of ourselves, but the guidance for 2026 almost made my head explode. We're going to go from guidance, they're guiding for 7 to 8 cents, and then 2026, 55 to 80 cents. Is that what I read? I mean, look at the EPS multiples, how they're changing in just 3 years. This company is undervalued. I don't know if you've had a chance to read the whole thing. I was just skimming it, but management's guidance was just, I don't understand how they're going to, sell it off from here. They may, and I'll bitch and moan like the Karen that I am, the giant Karen. But I mean, the trajectory of this company is just unmistakably bullish at this point. I mean, management can do whatever they want to do. And they've got some scale now. They have some flexibility. I'm more bullish than ever.
So let's talk about how there was a large way that they even got to this number. There was some change this quarter that I didn't quite understand. That was in the corporate revenue. Did you look through this, Chris?
No, I didn't see that part yet.
So in corporate revenue, instead of usually being about negative 20 million every quarter, it was positive, like 26 million or something.
Yeah, they cooked the books, Tanner.
Yeah.
That's what they do.
Hey, I'm happy
that somebody will actually take that seriously.
No, I mean, it's not in a bad way, but they can make adjustments. These guys, that's how accounting works. It's not bean counting. These guys are making strategic decisions years out that affect the accounting. I just think they can do what they want with these numbers over the short term. I mean, you can make certain adjustments and choose when you make those adjustments.
Sales and marketing barely, took a hit. They lowered it a little bit. Even whenever it comes to a lot of their expenses, they weren't it's not like they cut all the way down to make this number fit. They kind of just ran business as usual. And anyway, let's look at how they performed versus guidance, because this was a big one. I was so shocked by this. So if anyone saw my numbers, I put them pretty much halfway through guidance, and then I didn't even know how they could get to this adjusted EBITDA number. And then here we go. We see way past their 19% EBITDA margin at 21%, hitting 432 million, and net revenue also increased past their guidance, just a little over about 0.5% past their high guidance. So another outperformance by SoFi, doing that sort of sandbag beat and raise strategy that we're seeing. And then the same thing comes in whenever we look at Q1. So Q1, people are saying, okay, well, adjusted net revenue is kind of exactly where it is right now. EBITDA 100 to 120 is much lower than the 180. I don't think we'll probably hit the 180 again if they're guiding for this much lower, but still, once people look at the full year guidance, this is where we start to see a couple of questionable things. Lending segments is a little bit low. The only thing that first comes to my mind before I get some opinions around the panel here is SoFi has been continuously beating and raising. Why is anything going to change? So I think they're being very conservative here, but still, let's have a talk about it. So Tevis, you want to go first?
Yeah, sure. I mean, if you scroll back down, look at that EPS number. Tanner, you sort of nailed this on the predictions episode where you said SoFi is probably going to come in and initially set a anchor or a baseline number at 8 cents EPS because it's still higher than what the street is expecting. The street is expecting 5 to 6 cents for the full year. I mean, we already did 2 cents in Q4, and the fiscal or the full year 2024 hasn't even started yet. And so initially, right off the bat, without Q1 even having reported yet, they're expecting 7 to 8 cents higher than street expectations right off the bat. And so we expect that to increase throughout the course of the year because of the trend that we know with SoFi management. But that was the number that immediately, stuck out to me. 580 to 590 million in adjusted EBITDA, or 7 cents, 8 cents EPS, higher than the street expectations, immediately setting the tone for the year.
Chris?
Yeah, I'm sorry. So this quarter, they had $200 million of tangible book value growth. And the other thing is, I wonder if part of the, if you go up to the adjusted net revenue, I wonder if part of that is the fact that corporate revenue is probably going to not be as positive this time or in Q1 as it was in Q4. And so that's part of the reason that's going to adjust back downward. But again, they always, they guide very conservatively. They guide very for a bad macro environment, and that's one of the reasons that they continually beat it. So, when you look at these numbers on the surface, it's still good growth, right? But it's not excellent growth. But then when what they deliver is, I expect to be better than this. But the fact that one of the things that I was worried about, not really worried about, but curious to see, was whether or not they would guide for GAAP profitability in the first quarter, because I thought it might have been a thing where you hit it one quarter and maybe come down for the first quarter, or just slightly break even and then continue from there. But at this point, if they're guiding for profitability in first quarter, it's going to be from now on, right? Like, they're not going to go negative from there. So that's actually really good to see. And again, the fact that these numbers are always super duper conservative compared to what they deliver means that you're probably going to see something much better than this in the first quarter. But even if they were to hit these numbers, that's more than acceptable, right? And if they say $300 to $500 million in tangible book value, but in first quarter, they're getting 110 to 120 in adjusted EBITDA, which is pretty close to the tangible book value growth anyway. So I just think that, looking at these numbers, it makes me excited for what they're actually going to do, even though these numbers themselves aren't necessarily the most exciting to look at.
I think you hit the nail on the head. They're always very conservative. These actually seem more conservative than usual. And I don't know if that's just because of a less certain macro, whether we'll have that soft or hard landing when the Fed actually cuts. That may be the case, but I mean, just
incremental EBITDA margin of 38 to 44% is more conservative than usual.
No. I'm looking at EPS, tangible book value growth, GAAP net income, lending segment in particular. Those all seem really, really conservative.
Right.
So we'll see.
One thing I will say, just to add to that, is we looked at the Q3 slide for guidance on Friday, and I mean, we can flip to it, but I think if people go back and look to that, it shows you the initial guidance and then the Q2 adjustment and the Q3 adjustment.
Yeah.
It again here, but just measuring the difference of what it initially started at and what it ended at, it's almost like a double in terms of their initial guidance at the beginning of the year and what their guidance was for the fourth quarter at the end of the year when they knew their numbers.
Especially on the EBITDA side.
Exactly. So this can vary significantly, right? This is just a starting point.
So, guys, I just wanted to ask a couple questions before we go on. One, I have the call ready to go. It's going to come on in 5 minutes. Two, I saw someone type this in. I don't know if anyone has seen this story as well. Dan Dolov, who we look at a lot, he's very bullish on this company, just said that he expects share price to grow to $195 by 2030. Is that a real thing?
For SoFi?
Yeah, for SoFi.
I'd like that.
I love it. Yes.
I have
Hey,
not
you
looked
said
at
20X,
after
yes.
seeing earnings.
Yeah, I'm cool with that.
Okay.
I mean, I'll take it for sure, but I don't. It might be like for a firm or something.
Yeah, no. So the call is coming on, guys. Don't worry. People are saying don't miss it. I'm listening to the music right now. Don't you worry. We're not going to miss it. What else? So we saw. Let's get into a little bit more product specific numbers real quick because that's something that I always like to look at. Whenever looking at SoFi Money, which is always their big product lately, at least in these high rate environments, what we saw was an additional 310,000 new members. So I'd like to look. I'm probably going to do this. I think out of a percentage of new, yeah, okay, I already did the percentage. Never mind. So last quarter, whenever we added on 717,000 new members, as a percentage of the new products, SoFi Money made up for 35% of every product that we signed on to the platform. Now that number's at 44.7% of every product that people are coming onto the platform is for SoFi Money. Pretty incredible. That also led to a pretty fun number for a little blurry. Here,
because I'm blurring my background. It's up 10%
in the pre-market. $8.38 in the pre. But deposits went up by 2.9 billion, something along those lines. I think we're at where is it? 18 billion total. Got quite the long chart now. Anyone want to help me out here?
Deposits.
$18.56 billion now. And started collecting just about 2 years ago in deposits. So 18.5 billion in 2 years. Roy, what do you think? That's all people care about anyway.
I mean, they're executing, they're firing on all cylinders, and this has been the macro. This has been the time to really grow that number. Really, this helps fuel, of course, the lending segment. So just a phenomenally run company.
Got you. Danny?
Yeah.
I'm sorry?
Do you care about the deposits and the
the deposits and the tech side are all I care about. I mean,
Okay.
if you're going to give us value as a bank, I want deposit growth, and the real money is in the tech company. If we want stupid money like Tesla money, so I mean, yeah, deposits are really important. It's kind of the lifeblood of a bank. So it lowers our costs.
The tech
loans,
platform
so-
margin stayed high, so you should be very happy.
For me, deposits are just directly lead to profits. I mean, more profits, better margins. So every time I see
that's
that,
actually,
It's quite the opposite.
what's
it's
that?
actually really good deposit growth for the fact that they only added 585,000 members too, right? So that means that the older members are still contributing and going up.
Yeah, the direct deposit is key. I mean, SoFi has direct deposit numbers. Every time they announce them, they're hoping for 50, and they're always just much, much higher than management is guiding for. I think that's like, we look at the wrong things. Member growth, the direct deposit numbers, these really high quality, high earners are the key. SoFi just is cornering that super premium, young, affluent, up and comer. This company is going to be an absolute monster. Sorry, I know I'm always cheerleading, but I'm very excited.
No, I appreciate it. So, what else do you guys want to cover before we get on to the earnings call? Any last remarks?
So there's a lot of interesting things in this. Like this earnings is gonna take me a minute to figure out. Like there's some weird, not weird, but different things going on. Like normally this would have been about 5 cents of EPS, but there's like $20 million in adjustment. They switched some loans from held for sale to held for investment.
Saw that.
Anyway, so there's lots of details in this report that, having only had a half hour to look at, like we're speaking off the cuff, but there's going to be some things in here that'll be interesting to break down in the next weeks, and hopefully they'll cover some of these things in the earnings call and clarify them. So.
Well, a little confusing thing about EPS is that it's not like there's a little bit of a difference between basic EPS versus like dilutive EPS. And so the number can be different than what the total net income divided by just outstanding shares is. So, yeah, it's a little bit weird. I actually didn't see if they did post outstanding shares or if that was on the 10Q. I didn't get to see that.
It's usually on the
10K or whatever.
Press release. Weighted average common stock at 963 million shares.
That's about a 4 million increase.
No, it was about 950 million. I think it's like a 12 million increase. I think it was right around 950 after Q3.
Okay. Earnings call starting. Jumping over.
All right.
Mute up, everyone.
At this time, I would like to welcome everyone to the SoFi Technologies Q4 2023 and full year 2023 earnings conference call. All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question and answer session. If you would like to ask a question during this time, simply press star followed by the number 1 on your telephone keypad. If you would like to withdraw your question, please press star followed by 2. Thank you. With that, you may begin your conference.
Thank you, and good morning. Welcome to SoFi's fourth quarter and fiscal year 2023 earnings conference call. Joining me today to talk about our results and recent events are Anthony Noto, CEO, and Christopher Lapointe, CFO. You can find the presentation accompanying our earnings release on the investor relations section of our website. Our remarks today will include forward-looking statements that are based on our current expectations and forecasts and involve risks and uncertainties. These statements include, but are not limited to, our competitive advantage and strategy, macroeconomic conditions and outlook, future products and services, and future business and financial performance. Our actual results may differ materially from those contemplated by these forward-looking statements. Factors that could cause these results to differ materially are described in today's press release and our subsequent filings made with the SEC, including our upcoming Form 10-K. Any forward-looking statements that we make on this call are based on assumptions as of today. We undertake no obligation to update these statements as a result of new information or future events. And now, I'd like to turn the call over to Anthony.
Thank you, and good morning, everyone. 2023 was a remarkable year for SoFi. We achieved multiple records and realized many of our aspirations despite seismic geopolitical and macroeconomic events. We demonstrated that we have built a business to thrive in a host of challenging environments, reacting swiftly to change, driving our business forward with standout financial performance while continuing to serve our members' needs. Our 2023 results have reinforced my conviction in our long-term potential and our ability to achieve our aspiration to become a top 10 financial institution. I'd like to highlight some of our notable achievements for the year. We reached GAAP net income profitability in the fourth quarter and are positioned to continue to drive positive GAAP net income in 2024. We grew adjusted net revenue by 35% for the year to a record of $2.1 billion, while adjusted EBITDA of $432 million increased 200% versus 2022. This represents a 54% incremental margin and a 21% consolidated EBITDA margin for the full year, compared to our long-term margin target of 30%, which we achieved in the fourth quarter of 2023. Total members and products both grew over 40%, with 2.3 million new members in 2023 for a total of 7.5 million members. And we added 3.2 million new products for a total of 11 million products at year end. We continue to diversify our revenue with financial services and the tech platform contributing 40% of fourth quarter adjusted net revenue, up from 34% in the year ago quarter. Our financial services segment achieved positive contribution profit in the third quarter, which ramped further in the fourth quarter. We completed a dramatic shift in tech platform's product offering and focus, positioning us to capture the massive opportunity in the traditional banking sector, in addition to tech and consumer companies looking to provide financial services. In lending, 72% of adjusted net revenue was from net interest income compared to 48% in fiscal year 2022. Net interest income offers a more recurring and predictable cash revenue stream compared to non-interest income. We generated $334 million in tangible book value growth, which is now set to accelerate in 2024. Total deposits grew by $11.3 billion in 2023 to $18.6 billion, and over 90% of our consumer deposits are from direct deposit members. SoFi Bank reported net income of nearly $350 million, a 21% margin with a return on tangible equity of 15.9% in its first full year of formation. To put some of these achievements in the context of a longer-term perspective, I'll note the following. When comparing our business to fiscal year 2018, which is when I joined SoFi and we embarked on our new strategy, we have grown annual adjusted net revenue by more than 8x, annual EBITDA by almost 3x, or $660 million, members by more than 11x, total products by 16x, and consolidated net interest income by nearly 5x. And since adding several financial services products in 2019, we have grown annual financial services revenue to more than $430 million, financial services products to 9.5 million in total, and financial services products now comprise 85% of our total products. The fourth quarter really capped an exceptional year. Record adjusted net revenue of $594 million accelerated to 34% year-over-year growth, while record adjusted EBITDA of $181 million grew 159% with a 30% consolidated EBITDA margin. This EBITDA margin is up 14 percentage points year-over-year and is now equal to our long-term target of 30%. Financial services segment contribution profit grew to $25 million, an 18% margin versus $3.3 million last quarter and negative $44 million in the year-ago quarter. Our deposits grew by a record of nearly $3 billion in the quarter. Tech platform segment revenue growth accelerated to 13% year-over-year on its way to 20% next year, with a 32% contribution margin versus 20% in the year-ago quarter. In lending, 76% of adjusted net revenue was net interest income, up 43% year-over-year to $263 million. We point this out because $263 million in cash revenue is 2x greater than our directly attributable segment expenses of $120 million. Segment contribution margin improved by over 500 basis points sequentially to 65%. Company consolidated GAAP earnings per share was 2 cents, with GAAP net income totaling $48 million versus a $40 million loss in the year-ago quarter. SoFi Bank's net income of $129 million represents a 27% margin and an annualized return on equity of 16.8%. In terms of our balance sheet, we grew tangible book value for the sixth consecutive quarter by $204 million at the consolidated level, reaching $3.5 billion in total. Our total capital ratio improved to 15.3% from 14.5% last quarter, helped by organic tangible book growth, over $1 billion in loan sales, capital optimization moves, and an opportunistic convertible debt repurchase of $72 million. From a member and product perspective, in the fourth quarter, we added 585,000 new members for a total of over 7.5 million members and 695,000 new products for a total of over 11 million products. Now I'd like to spend some time touching on quarterly segment level results. Lending adjusted net revenue of $347 million grew 10% year-over-year against a difficult comparison of 51% year-over-year growth in the year-ago quarter. Personal loan originations grew 31% year over year to $3.2 billion. Student loan originations grew 95% year over year to $790 million. And home loan originations increased 193% year over year to $309 million. Within financial services, net revenue grew 115% year over year and 18% sequentially to $139 million, driven by continued strong monetization within the segment. We achieved $25 million in contribution profit despite our significant investment across money, credit card, and invest. As we noted last quarter, the credit card and invest businesses are still in heavy investment mode with losses of over $100 million annually on a run rate basis. Through unit economic optimization and greater scale, these businesses will eventually see positive contribution profit, similar to how we deliver with SoFi Money. We continue to see strong growth in SoFi Money products and, importantly, high-quality deposits and great levels of engagement. This has led to higher average account balances, even as average spend has increased. SoFi Money products have increased 54% year over year, or by nearly 1.2 million to 3.4 million accounts. As important is the quality of these members with a median FICO of 744 for a direct deposit portfolio, and hence we see ample opportunity for cross-buy. In terms of engagement, over 50% of our newly funded SoFi Money accounts are setting up direct deposit by day 30. This account primacy drives spending, which exceeded $1.5 billion in the fourth quarter debit transactions of volume. This is up nearly 3x year over year and represents more than $6 billion of annualized debit transaction volume. Our invest products, excluding crypto from all periods, grew 20% year over year to a total of 2.1 million, with AUM increasing 54% year over year. We've continued to launch exciting new products that meet our members' needs in financial services to further accelerate new member growth and cross-buy. Just today, for instance, we announced the launch of alternative investments and mutual funds. With the launch of alts, SoFi is granting yet another opportunity for everyday investors to access investment opportunities traditionally reserved for institutional investors and the ultra-wealthy. For our tech platform, revenue of $97 million accelerated to 13% growth year over year, up from 6% in Q3. We continue to make significant strides in our strategy of leveraging our unique product suite to pursue diversified growth and larger, more durable revenue opportunities. We started to see evidence of this strategy in the fourth quarter, as growth was driven not just by continued strong organic growth of existing partners and new product adoption by them, but also by notable contributions from increasingly diversified clients which have launched within the last 6 months. As mentioned last quarter, demand from traditional financial institutions and non-financial categories remains strong. While lead times for winning RFPs and ensuing integrations are measured in many quarters, not months, the transition to modern processing and modern cores is playing out in real time the way we envisioned it. On the product side, we continue to build and ship a diverse range of products for multiple sectors. Most notably, we launched an expense management solution in partnership with MasterCard that provides clients in the B2B sector with insights into corporate card spend. We launched same-day ACH, which allows account holders faster access to funds and helps mitigate risk tied to transactional delays. And we launched a risk data mart and data pipeline for our payments risk platform, which is seeing rapid adoption from existing clients. With that, let me turn it over to Chris for a review of the financials for the quarter and our 2024 outlook. I'll return to review our multi-year outlook after Chris shares his thoughts.
Thanks, Anthony. The Q4 and full year 2023 results really prove once again that our diversified and differentiated business model drives SoFi's durability and long-term growth potential. I'm going to walk through key financial highlights in our financial outlook. Unless otherwise stated, I'll be referring to adjusted results for the fourth quarter and full year of 2023 versus fourth quarter and full year of 2022. Our GAAP consolidated income statement and all reconciliations can be found in today's earnings release and the subsequent 10-K filing, which will be made available next month. For the quarter, we delivered record adjusted net revenue of $594 million, with growth accelerating to 34% year over year and 12% sequentially from the third quarter's record of $531 million. Adjusted EBITDA was $181 million at a 30% margin, which is our long-term target margin, up over 80% from the prior record quarter of $98 million. This represented over 14 percentage points of year-over-year margin improvement and 12 percentage points of sequential margin improvement, demonstrating significant operating leverage across all functional expense lines. In fact, sales and marketing declined as a percentage of adjusted net revenue for the fifth consecutive quarter. Total operating expenses declined roughly 17 points as a percentage of adjusted net revenue year over year. Overall, this resulted in a 74% incremental adjusted EBITDA margin year over year. We achieved GAAP profitability this quarter for the first time, with GAAP net income reaching $48 million, an $88 million improvement year over year, and an incremental margin of 55%. We saw continued year-over-year leverage in stock-based compensation, dropping to 12% of adjusted net revenue versus 16% in the prior year period, on our path to our longer-term goal of single-digit stock-based compensation margins. For the full year, we delivered $2.1 billion of adjusted net revenue, up 35% year over year from $1.5 billion in 2022. Adjusted EBITDA rose 201% year over year to $432 million at a 21% adjusted EBITDA margin. Our full-year net loss was $54 million and 10 cents per share, excluding the goodwill impairment charge taken in Q3. We exceeded the high end of our most recent revenue and EBITDA guidance by $9 million and $36 million, respectively, by leveraging our unique suite of products and services, nimble asset and resource allocation, as well as a relentless focus on unit economics and risk management. Now on to the segment-level performance. In lending, fourth quarter adjusted net revenue grew 10% year over year to $347 million, with $226 million of contribution profit at a 65% margin, up from $209 million a year ago. These results were driven by 43% year-over-year growth in our net interest income, while non-interest income was down by 36%, primarily driven by increased losses and prepayments. Growth in net interest income was driven by an 82% year-over-year increase in average interest earning assets and a 122 basis point year-over-year increase in average yields. This resulted in an average net interest margin of 6.02% for the quarter, up 3 basis points sequentially and 8 basis points year over year. I'd also highlight our $2.9 billion of deposit growth in the quarter compared to the $1.6 billion of net loan growth on the balance sheet. The 218 basis points of cost savings between our deposits and our warehouse facilities has resulted in a meaningful benefit to our net interest margin. It also underscores the benefits of having the option of holding loans on balance sheet when advantageous and collecting net interest income. We expect to maintain a healthy net interest margin and benefit from the continued mix toward deposit funding, along with our demonstrated high loan WAC betas. On the non-interest income side, Q4 originations grew 45% year over year to $4.3 billion and were driven by growth across all three products, even as we continue tightening and underwriting against our stringent credit standards. We saw typical seasonality and intentionally planned for lower originations in our personal loans business, with originations of $3.2 billion, up 31% year over year and down 17% sequentially. Our student loans business saw origination volume nearly double year over year and declined 14% sequentially to $790 million. Home loans grew by 193% year over year and declined 13% sequentially to $309 million. Our personal loan borrowers' weighted average income is $171,000, with a weighted average FICO score of 744. Our student loan borrowers' weighted average income is $154,000, with a weighted average FICO of 781. Our Q4 on-balance sheet delinquency rates and charge-off rates continue as anticipated to normalize back toward pre-COVID levels. Our on-balance sheet 90-day personal loan delinquency rate was 56 basis points, while our annualized personal loan charge-off rate was 4.0%. Our on-balance sheet 90-day student loan delinquency rate was 13 basis points, while our annualized student loan charge-off rate was 59 basis points. We continue to expect healthy performance relative to broader industry levels. In the fourth quarter, we sold portions of our personal loan and home loan portfolios totaling $1.2 billion, approximately $875 million in personal loans principal and $350 million in home loan principal. In terms of the personal loan sales, we closed a previously disclosed $375 million securitization with BlackRock, where we sold both bonds and the resid at an execution level of 105.1% and closed an additional $500 million of loans in whole loan form to multiple parties at a blended execution of 105.6%. These had similar structures to other recent personal loan sales, with cash proceeds at par or at a premium to par, and the majority of the premium comprised of the contractual servicing fees that are capitalized. These deals included a small loss share provision that is above our base assumption of losses and immaterial relative to the exposure we would otherwise have had if we held the loans. In the quarter, we executed $450 million of senior secured financing, which will show up on our detailed balance sheet as senior secured loans held for investment at amortized cost. These loans have a fixed term structure and are secured against the underlying assets, therefore equivalent to investment grade bonds if you were to do a securitization for the same pool of collateral. In addition, these loans are priced at market rates, which not only helps to diversify our balance sheet, but also provides an additional return above our cost of funding and a yield similar to the net interest margin of our loans, which are unsecured. Now turning to our fair value marks and key assumptions. Our personal loans are marked at 104.9% as of the year end, up from 104.0% at the end of Q3. This was a function of the discount rate decreasing by 103 basis points, which was driven by the underlying benchmark rate declining by 90 basis points and spreads tightening by 13 basis points. Notably, the benchmark rate change and the spread change are empirical, as they are actual market observed inputs, not assumptions. Partially offsetting the decrease in discount rate was an increase in the annual default rate assumption from 4.6 to 4.8%, as well as an increase in the annual prepayment speed assumptions from 20 to 23%, which has an immaterial impact on the overall change in the mark. When a borrower prepays, we are still capturing the principal, and the impact to the value of the assets is only based on the premium above par at a given point in time, which is very small relative to the principal outstanding. We expect default rates to continue to normalize to pre-COVID life of loan loss levels of approximately 7 to 8%. For our student loan portfolio, the fair value mark at year end increased to 103.8% versus 101.5% at the end of Q3. This was a function of the portfolio WAC increasing by 24 basis points and the discount rate decreasing by 57 basis points, driven by the underlying benchmark rate declining by 86 basis points and spreads widening by 29 basis points. Partially offsetting the decrease in discount rate was an increase in the annual default rate assumption from 0.5 to 0.6%. Importantly, the fair value benefits resulting from interest rate decreases as well as personal loan spread tightening was offset nearly 1-for-1 by hedge losses and spread widening in our SLR business. So there was no net revenue benefit in the quarter due to discount rate input changes. For the full year, lending adjusted net revenue grew 21% to $1.3 billion, and the segment delivered $823 million of contribution profit at a 62% margin. Moving on to financial services, where net revenue of $139 million increased 115% year over year, with new all-time high revenue for SoFi Money, credit card, and lending as a service, as well as continued contributions from SoFi Invest. Overall monetization continues to improve, with annualized revenue per product of $59, up nearly 50% year over year versus $40 in Q4 2022, and up 10% sequentially. This is driven by higher deposits and member spending levels in SoFi Money, greater AUM and monetizable features in SoFi Invest, and robust growth within SoFi credit card spend. We reached 9.5 million financial services products in the quarter, which is up 45% year over year, with 626,000 new products in the quarter. We reached nearly 3.4 million products in SoFi Money, 2.4 million in SoFi Invest, and 3.3 million in Relay. Contribution profit reached $25 million for the quarter, even as we continue to invest aggressively against the ample opportunities to rapidly grow this operating segment with attractive returns. Full year segment revenue of $437 million is 2.6 times the $168 million we delivered in 2022, and we broke even on a contribution basis for the full year. Shifting to our tech platform, where we delivered record net revenue of $97 million in the quarter, up 13% year over year and 8% sequentially. Annual revenue growth was driven by continued monetization of existing clients, along with new deals signed in new client segments. Galileo accounts grew 11% year over year to $145 million. The segment delivered a contribution profit of $31 million, representing a 32% margin. We continue to leverage investments made to integrate Galileo and Technisys and position the segment for higher rates of diversified, durable growth going forward. We expect tech platform revenue to continue accelerating in 2024 with strong margins. For the full year, the tech platform segment grew revenue 12% to $352 million and delivered $95 million of contribution profit at a 27% margin. Switching to our balance sheet, where we remain very well capitalized with ample cash and liquidity. In Q4, assets grew by $2.1 billion as a result of $1.6 billion growth in loans and approximately $400 million of growth in cash, cash equivalents, and investment securities. On the liability side, deposits grew by $2.9 billion sequentially to $18.6 billion. Importantly, deposit growth outpaced net loan growth for the fourth consecutive quarter. As a result, we were able to reduce warehouse facilities utilized by over $700 million, resulting in more efficient funding costs as we continue to ramp the portion of loans that are funded by deposits. We exited the quarter with $3.2 billion drawn on our $9 billion of warehouse facilities. We grew tangible book value for the sixth consecutive quarter by a record $204 million to nearly $3.5 billion. In the fourth quarter, we opportunistically executed the buyback of a small portion of our outstanding convertible bonds, which was additive to our GAAP net income by $14.6 million, accretive to GAAP EPS, and additive to our total risk-based capital ratio by more than 30 basis points. Additionally, we entered into a credit default swap arrangement for $2.5 billion of refinanced student loans. These loans were reclassified as held for investment versus held for sale based on the fact that we intend to hold these loans until maturity, given the more attractive returns relative to pricing trends we see in the market today. We do not expect to see that price dynamic changing. The reclassification is consistent with fair value accounting practices and has no overall impact on our revenue and profitability. The credit default swap, however, does improve capital ratios as it significantly lowers the risk weighting for these assets and increased our total risk-based capital ratios by greater than 1% in the quarter. In terms of our regulatory capital ratios, our total capital ratio of 15.3% at year-end improved from 14.5% last quarter and remains comfortably above the regulatory minimum of 10.5%. Let me finish up with our outlook. Before going through specific numbers, I want to review some of the larger macro assumptions that underpin our financial guide. We assume a contraction in GDP in 2024, an increase in unemployment to higher than 5%, and broadly, a continuation of uncertain capital markets activity and continued normalization of consumer credit. From an interest rate perspective, we are assuming 4 rate cuts in response to a contracting economy, higher unemployment, and deterioration and normalization in credit performance, with Fed funds rate reaching approximately 4.5% by Q4 2024. Before I summarize 2024 annual guidance, I want to give some high-level thoughts by segment. 2024 will be a transitional year for SoFi, as the tech platform and financial services segments together will drive our growth and increase from 38% of total adjusted net revenue in 2023 to approximately 50% for all of 2024. Specifically, we expect our tech platform and financial services segments, when taken together, to grow 50% or more, with the financial services segment growing approximately 75% year over year and tech platform growing approximately 20% year over year. We are taking a conservative and pragmatic approach toward our lending segment revenue, expecting to largely maintain it, given our concerns about the 2024 macro environment as it relates to uncertainty on rates, the economy, and industry liquidity. Therefore, we will manage the lending segment revenue to be 92 to 95% of 2023 lending revenue. This very conservative view of lending reflects our choice to limit lending growth below both the much higher level of demand we have had and expect to continue to see in 2024 and the capacity that we have. Fortunately, for us, the scale and profitability we have achieved in our tech platform and financial services segments allows us to intentionally limit growth of our lending businesses in periods of uncertainty while still maintaining an attractive overall growth rate, significant profit, cash generation, and book value growth. Even with our conservative view of the lending business, we expect 50% growth in revenue of tech platform and financial services combined, and to add at least 2.3 million new members in 2024, which represents 30% growth. Within lending, our personal loan originations could be relatively flat or down versus 2023, while student loan originations could grow just modestly, and home loans growth could be correlated with rate decreases. In terms of capital and liquidity, our total risk-based capital ratio improved to 15.3%, up from 14.5% in Q3, demonstrating our ability to effectively manage our balance sheet and capital ratios through growth in GAAP net income, opportunistic capital efficiency transactions, and loan sales. In terms of our lending capacity, we have the ability to originate $18 to $20 billion in loans in 2024, while keeping capital ratios well north of regulatory minimums, and that's based on growth in tangible book value, amortization of existing loans, and previously announced loan sales. To be specific, we expect to generate $300 to $500 million of tangible book value in 2024, which translates to approximately $2.4 to $4 billion of incremental capacity. Second, loans are amortizing or paying down at an annual rate of $8.4 billion. Third, we have our previously announced $2 billion forward flow agreement, in addition to a number of on-the-run loan sale transactions we expect to execute, similar to the sales achieved in Q4. And lastly, we have headroom in our capital ratio. Having said that, we intend to originate less than the $18 to $20 billion in capacity, and this is based on the factors I outlined previously. With that, let me turn to specific guidance. For 2024, even with our conservative view of the lending business at 92 to 95% of 2023 revenue, we expect 50% growth in revenue of tech platform and financial services combined, and to add at least 2.3 million new members, which represents 30% year-over-year growth. We anticipate adjusted EBITDA margins of approximately 20% in the first quarter, ramping to our long-term target margin of 30% by year-end, which equates to a range for 2024 EBITDA of $580 to $590 million. For the full year 2024, we expect expenses under the EBITDA line to be roughly equivalent in aggregate in dollar terms compared to 2023, excluding the 2023 reported goodwill impairment expense. That equates to full-year GAAP net income in the range of $95 to $105 million and GAAP EPS in the range of 7 to 8 cents. We expect growth in tangible book value of $300 to $500 million for the year, and to end the year with a total capital ratio north of 14%. For Q1 2024, we expect to deliver adjusted net revenue of $550 to $560 million, adjusted EBITDA of $110 to $120 million, and GAAP net income in the range of $10 to $20 million. Now let me turn it back to Anthony for thoughts on our medium-term outlook.
Given the number of milestones we have achieved since we transitioned the strategy of the company when I joined 6 years ago, as well as the fact that 2024 will be a transitional year, we thought it would be helpful to provide a longer-term perspective beyond 2024. For the 2023 through 2026 time period, we see 20 to 25% compound annual revenue growth, assuming no meaningful change in the macro environment and no significant new business launches or acquisitions, such as small-medium business checking and savings, or small-medium business lending, a broader asset management business, insurance, a broader credit card portfolio, new technology verticals for the technology platform business, or new geographies. The 20 to 25% compound annual revenue growth from 2023 through 2026 assumes a compound annual growth rate of 50% for financial services revenue, mid-20% for tech platform revenue and mid-teens for the lending segment revenue. Simply put, this growth only reflects the benefits of the investments we've made in our existing businesses paired with continuing to build brand awareness, trust, and adoption by new members and driving cross-buy from existing members. The earnings power associated with this growth is notable and could drive between 55 cents and 80 cents per share in GAAP EPS in 2026. Moreover, we see 20 to 25% EPS growth beyond 2026, reflecting both the continued growth of the core businesses we just described, plus the added benefit from new business lines launched in the 2024 through 2026 time period that begin to scale and impact beyond 2026. Make no mistake, the long-term opportunity for SoFi remains unchanged, and we continue to believe we are just getting started. There are endless opportunities for investment and growth, and we remain focused on the right types of durable growth for the stage of our company and within the environment in which we operate. In summary, we could not be more proud of the results of SoFi in 2023, or even more encouraged by the prospects ahead of us. We have demonstrated the benefit of having a member-centric approach and being a one-stop shop to help our members get their money right, resulting in having a diversified, high-growth set of revenue streams, multiple cost-efficient sources of capital, a keen focus on underwriting high-quality credit, and a high degree of operating leverage as we scale the business to be the winner that takes most in the digital financial services sector. With that, let's begin the Q&A.
Love that.
If you would like to ask a question, please press star.
I like how they
on your
give a
telephone
roadmap for
keypad.
what products they're
If you
not
would like to
going to be
withdraw your
getting
question,
into.
please press star followed by 2. When preparing to ask your question, please ensure you are unmuted locally. And please keep in mind we'll only take 1 question per person at a time. Please rejoin the queue for any additional questions. So as a reminder, that's star 1 on your telephone keypad. Our first question today is from John Hecht from Jefferies. John, please go ahead. Your line is open.
Yeah, good morning, guys. Thanks very much for all the details about the intermediate term goals, and appreciate you taking my question. You guys are taking a fairly conservative look at the economy. I think that's dictating or guiding kind of how you want to balance the growth between the lending segment and the non-lending segments this year. Anthony, I'm just wondering if things kind of pan out a little better than expected, would that change the trajectory? And then how do we think about kind of lending segment versus non-lending segments as we get into next year?
Yeah, I think if the economic backdrop is vastly different, it'll change the trajectory, both up and down. I would think about that both ways. Could be worse, could be better. As I think about the different businesses, some things that could give us tailwind, if we do see rate declines, our home loan business really would benefit from refinancing in the mortgage business and would benefit from greater purchases. Right now, rates are quite high and it stifled the growth in that market, but that would be a benefit. We really love the home loan business for a couple of reasons. Number one, it's probably the largest and most emotional financial decision people make in their lives. And if we're going to be there for a relationship with our members, we have to be there for that decision. It also is one of the most risky. If someone overpays for a house or takes on too much debt in their mortgage, it could eliminate their ability to have discretionary income to invest. And if you do that in your 20s and 30s, it's really hard to catch up later. So it's a really critical product for us delivering on our mission. It's also a great economic product. We largely do agency mortgages, which means we use our capital just to underwrite it, but then we can sell it to the government agency windows, which benefits the balance sheet quite meaningfully. So that's one business that would be capital light. Generally, if we do agency mortgages, that would benefit from lower rates. The second business that would benefit from that is as rates come down, you'll see more people looking to get yield in other products like invest. An offset to rates coming down, some may believe that our SoFi Money product may not grow as fast. What I'd say is from an interest rate standpoint, we are committed to providing a top tier APY in addition to no fees and all the functionality that we provide with 2-day early paycheck and the ability to earn reward points and do person-to-person payments and bill pay and all the other benefits of that product. But because we are an originator and we do generate yield against those deposits, as you know, 6.1% this quarter, we're going to be able to maintain a competitive advantage in what rate we give on SoFi Money. I would say if the rate cuts are in fact 6 times instead of what we're forecasting at 4, I do worry about the economy. I don't see a world in which we have 6 rate cuts and we have a strong economic backdrop. The market quickly switched from in late October, going from higher for longer to 6 rate cuts in a matter of 90 days. That tells you how bifurcated the market is and how concerning things can switch so quickly. So we want to be conservative in our outlook as it relates to risk. We have the benefit of being able to be conservative in our outlook because of what we've done in growing the financial services segment and the technology platform segment. And now that the financial services segment is profitable on a contribution profit basis, we can grow even faster and it doesn't drive our losses up. We're still in significant investment mode there because of the acquisition cost on Invest and on credit card and on SoFi Money. But overall, it's profitable and we can grow it very fast and benefit from that high margin revenue, the margins increasing. And same thing with the tech platform. We invested meaningfully over the last 3 years in the tech platform. We're now in margin expansion mode and revenue acceleration mode. So having all 3 businesses is a direct result of our broad-based strategy of giving consumers what they need to get their money right, but it also results in more durable and diverse revenue streams. In the situation where the economy is weaker than expected, losses will go up. We've seen trends across the industry. The all bank data is very telling in charge-off rates and delinquencies, as well as reserves for losses that indicate that normalization is happening across the spectrum. And we want to be prudent and make sure we factor that into our risk profile. Next question.
Thank you. Our next question today is from Andrew Jeffrey from Truist. Andrew, please go ahead. Your line is open.
Hi, good morning. Appreciate you taking the question. Anthony, I wonder if you could talk a little bit about the company's anticipated balance between growth. I'm thinking specifically in the financial product segment and profitability. You've achieved, at least this quarter, your long-term margin targets, and ostensibly you continue to generate really good LTV to CAC. So are there any factors that limit growth in terms of the financial products segment, or could we actually see that accelerate as the business becomes a little more balanced away from lending?
Thank you for your question. The contribution margin in that business, was break even for the full year and improved meaningfully in the fourth quarter. I would say the major limit on our growth in the financial services segment is how much we want to spend on building awareness and marketing. We have really good customer acquisition cost profiles in the businesses, especially SoFi Money. It's got the best payback period, but we're doing really well in Invest. Investors shouldn't go to sleep on our Invest business. As we mentioned in the call, the AUM increased more than 50%. We launched alternative asset classes today. We continue to give consumers access to products that are typically only available for the wealthy, and we're bringing them to Main Street. We did that with IPOs and now with alternate investments today, which we'll continue to build out also. And then the credit card business, we've really hunkered down there and pulled back to make sure we have the credit profile right, our market segmentation right, and most importantly, like we did in Money, make sure we have the unit economics right. And I feel like we've made great progress there. So within that segment, it really comes down to how much we want to spend in driving marketing. The products have payback periods anywhere from 12 months to 36 months. So ultimately, we want to manage the overall business to a 30% incremental EBITDA margin. And so we'll invest up to that point. And that's how to think about the limit to growth. But in terms of the opportunity, if we wanted to spend more and not hold ourselves to that balance between growth and a 30% incremental EBITDA margin, we could grow even faster. The market, the product market fit is so great. It's just a question of how much you want to dial it up or down.
Thank you. Our next question is from Reggie Smith from JP Morgan. Please go ahead. Your line is open.
Hey, good morning. Thanks for taking my question. Chris, I think you said that personal loan charge-offs were 4%, I believe, for the full year. I was wondering if you could tell us what that was for the fourth quarter. I guess my math and it could totally be off. I had you guys at like 3.1 through the first 3 quarters of the year. and that would imply, I think, like a 6% loss rate in the fourth quarter. So I don't know if I'm wrong there. Like any color there would be helpful.
You're wrong.
Yeah, no worries. Hey, Reggie. In terms of the fourth quarter, what you heard in my prepared remarks was accurate for the fourth quarter. So our NCO rate for the personal loans business was 4.0%. That was up from 3.44% in Q3 of 2023. As Anthony had alluded to, we do expect a continued normalization towards pre-COVID levels and life of loan losses in the 7 to 8% range.
Next question.
Thank you. Our next question is from Dan Dolev from Mizuho. Dan, please go ahead. Your line is open.
Thank you. Hey, guys. Excellent quarter. Nice work. Anthony, maybe question for you. You provided, nice outlook on profitability into 2026. Can you maybe give us your comfort level on the long-term earnings power of the business? Thank you.
Yeah, I think that there's two important indicators for the long-term earnings power of the business, which is what have we done to date, and then what's the sort of incremental way to think about profitability. So 30% EBITDA margin in the fourth quarter is a huge milestone for us. I cannot tell you the number of people that I mentioned our long-term margin at 30% to that were naysayers there. So I'm really proud of the scale that we've achieved at over $2 billion of revenue, but equally proud of what we've done from a profitability standpoint. To have 35% revenue growth, which accelerated with a 30% actual EBITDA margin and GAAP profitability, shows you the earnings potential of this business. The margin could be much higher than 30%, but we're sticking to that as our long-term margin today. As I think about 2026 in that time period, a margin profile in the 30s is what would help us get there and would make it achievable. If you think about our businesses individually and then collectively as a series of unit economic businesses where we're architecting the revenue per account, the variable cost per account to variable profit margin that obviously exceeds the customer acquisition cost by a meaningful margin and then pays back after 12 to 24 months. As you scale that variable profit per account, you're going into fixed cost base. Once you get that above the fixed cost base, the incremental unit economics just drops to the bottom line. And our unit economics are greater than 30%, which means our long-term margins could be greater than 30%. But we're going to stick with that right now for our long-term margin. It's quite surprising we achieved it so early while we're still growing. So that should be a great indication of what the future could bring. But we're not going to push it higher than that because we want to make sure we hold ourselves accountable to some constraints on what we invest in while balancing growth versus profitability and marching towards higher ROE and greater tangible book value growth.
Next question,
Thank
please.
you. Our next question is from Jeff Adelson from Morgan Stanley. Jeff, please go ahead. Your line is open.
Hey, thanks, guys. Appreciate you taking my questions. I just wanted to follow up on Reggie's question a little bit and dig in on the credit on the personal loan book. I know you did modestly increase the life of loss expectation there to 4.8% this quarter. I guess when we look at some of the ABS data, it does look like the data continues to get worse. And, we have other lenders out there in the consumer world that have flagged that, losses should also get worse this year. So I'm wondering if you could help us frame where you have your expectations for 2024 credit on the loss side going there. Is there a world where you see that overshooting the kind of 4.8% life of loan expectation this year, or do you think that it could kind of hold there? And then as a follow-up, I'm wondering if you could also provide the dollar benefit to NII you got this quarter or revenues this quarter from the new secured financing you announced. Thanks.
Yeah, sure. So on the actual PL losses, I just want to be clear. When I mentioned the 4.0% NCO rate, that was an annual loss rate. Where we expect it to normalize to is 7 to 8% life of loan, which translates closer to a 4.8 to 5-ish% annualized loss rate, which we expect to occur in the first half of 2024. The reason that we get confident that we are going to peak out at those levels is that if you look at our NCOs for Q4 of 2023, about 15% of those net charge-offs are related to credits that we have removed from the system, and that comprises about 3% of the overall UPB on the balance sheet. That's expected to get down to less than 1% by the end of the year. In terms of your second question around the benefit from revenue from secured financing that we announced, we did about $450 million in the quarter, as I alluded to in my prepared remarks. The actual revenue generation associated with that in period was immaterial given time of sales.
And the only other thing I'd add is that our backdrop for credit and credit performance and normalization is tied to our economic outlook. Obviously, in a more challenging economic outlook, those assumptions would likely not hold to be true, and we'd obviously manage the business differently. I would say the one thing that's been true of the last 6 years that I've been here is whatever we thought would happen with the economy isn't actually what's happened with the economy, and we have to be nimble and smart and read all the macroeconomic data points in our own business performances to adjust accordingly. So I don't want anyone to think that the outlook that we have is in all economic backdrops. It's not. It's for the very specific one that we outlined.
Next question, please.
Thank you. Our next question is from Michael Ng from Goldman Sachs. Michael, please go ahead.
Hey, good morning. Thank you very much for the question. I appreciate all that revenue guidance by segment for 2024. I was just wondering if you could talk a little bit about the contribution profit outlook, key things to consider for each segment, and any specifics around 2024 by segment would be helpful. Thank you.
Yeah, the way I think about it is the lending business is meaningfully profitable, very high contribution profit margins there. For those who have been following us for a long time, you'll remember the comments that was made about ensuring that our loans have a 40 to 50% variable profit margin per loan, so that those loans will be durable through the cycle, and we remain focused on achieving that. The second thing I'd say is on the technology platform, the margins contracted there quite meaningfully prior to this year as we invested in moving to the cloud from on-prem, and we invested in new architecture and new products and services, and we're now seeing the benefit of those investments coming in higher revenue and more operating leverage, and you saw the nice contribution profit margin expansion there, which you can continue to see with more revenue. It's a business that once you exceed your fixed cost, the incremental profitability is quite meaningful. And in the financial services segment, it's a lot harder to talk homogeneously because there's so many different businesses there. Chris said on the call that we're losing over $100 million a year from a contribution profit standpoint across the different businesses we're investing. Despite the fact that we achieved $25 million in the quarter of contribution profit, we're still losing meaningfully in businesses like credit card and SoFi Invest because of the acquisition costs there, but also because the fixed costs are not covered by the variable profit yet. And so that business has a lot of upside in contribution profit, but you have to think about it by business and where those businesses are in their development cycle. And so Invest and credit card are very early in their investment cycle and therefore losing a lot of money. SoFi Money is now variable profit positive and carrying the weight of the profitability of their overall business. We also have some ancillary businesses in there that are high margin, that are small dollars, that contribute nicely, but they're not the biggest contributor to that area.
Next question.
Thank you. Our next question is from Vincent Caintic from Stephens. Vincent, please go ahead. Your line is open.
Hey, good morning. Thank you for taking my questions, and I appreciate all the details. Going back to the rate cut expectations, I wanted to focus on sort of your expectations for how that affects loan sales and what your pipeline looks like for loan sales. Should we expect a acceleration in loan sales in 2024 if rates continue to go down? And then on the fair value mark, does the current fair value marks actually reflect the 4 rate cuts already, or should we expect that discount rate to decline and therefore increase the fair value mark as time goes on? Thank you.
Yeah, sure. In terms of the overall demand for our loans, the demand remains extremely robust. You saw that we did over $1 billion of sales in Q4, 875 of which came from unsecured personal loan sales, with a $375 million securitization and $500 million of sales in whole loan format. We do expect demand to remain robust. We're seeing that already in Q1. As a reminder, we do have a $2 billion forward flow arrangement in 2024 with a party that has bought loans from us over the course of the last few quarters. That will stay intact throughout the year. And then we do expect robust demand on other on-the-run loan transactions that we've done akin to what we did in Q4. So overall, really good demand at strong execution levels, as demonstrated in my prepared remarks. In terms of the fair market value marks, do these include the 4 rate cuts already? Our marks are reflective of a point in time. So as of the end of Q4, the marks reflect what the underlying benchmark rate as of December 31st.
So they don't reflect the 4 rate cuts going forward. The other thing I'd say is, as we think about our durability of our loans, we have continued to reduce our credit box. In late December, we reduced underwriting by eliminating what we call tier 6 and 7, which is the higher end of our FICO band. As those that know the company, we underwrite 680 FICO and higher, and our average is much higher than 680 in the mid 7s, as we talked about earlier. But as we progress through the year, we have reduced our credit box, and we continue to do so. And in December, making a relatively big change on 6 and 7, so that our loans are durable through the cycle, whether we hold them on balance sheet or we sell them.
And then the only other thing I would add, just to follow on to my point around do the marks include the 4 rate cuts? As you all know, we hedge interest rate exposure on our loans. So when interest rate drops, the value of the loan increases, but that's offset by hedge losses. Similar to what happened in Q4, we saw meaningful interest rate reductions, but we also had meaningful hedge losses that offset that.
Thank you.
Next question, please.
Our last question we have time for today is from Dominic Gabriele from Oppenheimer. Dominic, please go ahead. Your line is open.
Hey, guys. Thanks so much for the question and the color across the call. So maybe, Anthony, you can talk to us, or Chris, through the assumptions that lead to your mid 20% revenue growth within the tech platform. That'd be really helpful. Maybe including, if possible, breaking it down by the new client wins, pipeline for deals, customer adds, anything you can provide. I feel like this target's likely going to be of significant importance moving forward. Thanks so much.
Drop the tech client logos.
Yeah, we're not going to get into that level of detail. We're in market in conversations with dozens of potential partners across the spectrum of the diversified customer base we have. We have ongoing dialogue with everything from government-related deals for child support and benefits from the federal government, all the way to new consumer financial services offerings from large established non-financial services brands, all the way to big, large traditional banks in our country. The drivers of the business are quite simple. We have an underlying payment processing platform that you should think about generating revenue based on 2 factors. One, getting paid based on the transactions that occur in that platform, the volume of those transactions, and the price for those transactions, in addition to the APIs that we provide. Within the technology processing platform, we provide APIs for account opening, for bill pay, for 2-day early paycheck, for person-to-person payments, for payment risk platform fraud capabilities. And so different partners use different APIs, and the more they use, the more we get paid. But it also drives the more transactions. In addition to that, we have other products like Connecta, which is a natural language chatbot that uses machine learning. We also have a product called Payment Risk Platform, where we're helping people decide instantaneously on the risk of a transaction and whether or not it should be authorized or not. And we get paid for each one of those authorizations. In addition to that, we have Technisys' banking core, which is a much larger decision for any institution to use, but think of a core as an operating system. Our Technisys capability we bought for one big reason. We have a lot of products at SoFi. Those products all have different operating systems. We want them to run on one platform, one operating system, and we want that system to be extensible into new products that don't even exist today. In the financial services industry, many banks, many financial companies have many cores. In fact, they probably have more cores than products because many of them were aggregated roll-ups of other banks that had different cores for checking and savings, not to mention they have different cores for products like credit card versus checking and savings, or even for loans. And so Technisys enables a company to have one platform running different cores for different products, and it's extensible into different areas. One example of that is SoFi's Buy Now, Pay Later. We launched Buy Now, Pay Later with Galileo and Technisys and SoFi. It was the first product on all three technologies, and we did it in a very short period of time, and it's a great product that is easy for the consumer to use and can be authorized right in the application itself. And so that is another driver of the overall revenue streams. We also do services for digital solutions. We do build front ends for apps in addition to other types of digital services as it relates to the app and product development. So there's no one answer to your question other than more partners, more accounts, and more products per account, which drives the revenue from those factors that I just laid out. That ends our prepared remarks and questions. I wanted to finalize our comments today by just sharing with you some final thoughts. I'll finish here by saying how proud I am of our team's relentless ability to not just persevere through the disruption and volatility of the industry throughout the year, but to deliver record results. I couldn't feel more blessed by more than 7.5 million members that have been so critical in making our vision of being a one-stop shop for all your financial needs become such an amazing reality. The benefits of our strategy resulting in a uniquely diversified business that is unmatched by any digital-only provider in our scale, capability, and competitive advantages not only position SoFi to be the winner that takes most in the sector of transition of financial services to digital, but also provide greater durability through a market cycle. I'm excited about where we are today and even more excited about where we can go from here. Thank you for dialing into our call, and we look forward to talking to you next quarter.
Great
Goodbye.
call. Goodbye. That was a great call.
That was awesome.
Yeah.
I love how there can be, the occasional thing that comes up in the earnings call or something that can be kind of bearish, and they instantly clear things up on the actual call. I had a lot of questions. I didn't catch every detail, so I'm going to wait for Seeking Alpha to post that transcript, which will probably be in the next 2 hours. But what did you guys think? What was your first thoughts? Danny?
I was distracted by the woman's accent on the intro.
Yeah, I saw a lot of comments about that.
Yeah, I'm always impressed with both Noto and Lapointe, just incredibly in command. A lot of CEOs tend to be sort of aloof MBA doofus types. Noto's engineering background just shines. I mean, I always feel like we have two CFOs, the way he has command of the numbers. And I honest to God don't understand things at the level where I can pick through this. I have to kind of go back, but I'm just looking at the overall picture, and I just see again, like SoFi always hitting singles, doubles. It's just great for the long-term investor. I feel better than I did after Q3, and I felt great after Q3, and just gonna, if they push the price down, I'll just continue to buy the stock forever. I love Noto. I love SoFi.
Tevis, what were your first thoughts?
After covering this company for a while, you just start to realize, you can translate all of the analysts' questions by reading between the lines, and most of them are really dumb things that they've already covered in the prepared remarks. And it's just ridiculous to me because they ask something, for clarification, and then Chris Lapointe literally verbatim repeats something in the prepared remarks, and they're like, "Oh, okay, cool. Thanks for clarifying that. My math must have been wrong." And then 2 days later, they're like, "Downgrade." It's so crazy to me. But I think with regards to some of the prepared remarks that LaPointe was saying, rates are increasing, the coupon rates, annualized revenue per product is up, contribution profit's going to be pretty strong, reducing warehouse facilities by quite a bit. The amount that they have drawn on their warehouse facilities is not that much, 3.2 billion out of 9 billion as of Q4. Their assumptions were really bearish. And somebody asked about that. They were like, hey, these assumptions are really bearish. And I was like, yeah, idiots, they're sandbagging. Like, what do you think? Above 5% unemployment for 2024, and then 4 rate cuts with the Fed funds rate reaching 4.5%. So I do think that, and the first guy at Jefferies asked, he's like, oh, well, if the economy is better, does this change the trajectory? It's like, yeah, no shit, dude. It obviously changes the trajectory of the company. I think all around pretty solid call. Anthony Noto sounded in high spirits from the opening remarks all the way to the close. And a lot of the question and answer period just validated that, right? The pipeline for loan sales, they talked about the 1 billion plus loans sold in Q4 and how the demand remains pretty strong going into 2024, and that they've continued to reduce their credit box further so that the loans are just more durable in general. Overall, like really, really great, strong call.
Roy?
Yeah, on top of already strong results, the call was very strong. Like Tevis said, if we had questions going in with just the numbers that were presented and like, okay, where did they get this? Why are they assuming this? And they hit all those in the call. And so you can tell this is a company that knows how the bears think. And some of them ask questions. And so it was just great that they were like ahead of the game. They didn't have to, like they've done in the past. And it's a great thing when they do, with Chris LaPointe coming out to clarify some things. Always beneficial. But if they can head those things off on the front end, and then maybe a bear will come out and say, well, I still believe this anyway. Well, fine, you can live in your delusional fake reality all you want, but bottom line is SoFi is very, very conservative. So of course their biggest people regard SoFi as a bank. And it is more than a bank, but they're bank-ish in their conservative view. So banks typically are not going to guide to the moon. They're going to guide very, very conservatively. And so you saw that in what they were expecting with delinquencies, as far as how they're approaching their loan profile, as far as their guidance for 2024. And so all those things. And I'm with Tevis that this is, at this point with this company, you're just like, yeah, they're going to beat. We know that they're going to beat. If they don't beat, it's like, well, I wonder why. So there's maybe something a little bit bigger underlying. But even with their conservative assumptions, this is a very attractive looking company that we should all be very excited about. The price, so the price and the stock action is extremely volatile, and I expect that will not change. But the company itself is the opposite. You know what to expect quarter in, quarter out. They do a great job with this. I love being invested in SoFi.
Boom. Boom from Big Roy. All right.
These comments rolled in, Roy, as you were talking. Mark was like, I'm going to make Roy my beneficiary and just,
Yeah, a lot of very exciting things. I want to go back and, especially with the calls, I'm not great at doing all the notes. So I need to go back and review the transcript to get all those numbers that they said. There was a lot of detail in this. I loved how far they went. They didn't go as far as we want in the tech platform side of things. They said, hey, can you tell us more about the tech platform? No, we can't. But, can't ask for everything, I guess.
Look, the thing that I really love at a high level, guys, just for the people watching, is that what annoyed me before, literally 1 quarter ago, like Q3, people were saying, oh, well, it's still an unprofitable company, even though management had said like 7 or 8 times throughout the year, we're going to be profitable at Q4. And so it was a formality at that point. Now, nobody can freaking say that, because you can use that same stupid logic reversed to say, well, actually, the last quarter was profitable, so they are a profitable company now, and they're guiding for profitability for all future quarters. And so no bear can hold that over our head anymore to say, well, they're actually an unprofitable company, so therefore I'm not going to invest in the stock. They're not. They're profitable now officially. So, that argument is gone.
And it's a silly semantic argument when you're on a trajectory to make a profit. It's like ridiculous. I view it as like telling a 5-year-old kid, like, hey, stupid, you're not 6 feet tall yet. Like, what's wrong with you? It's like, I'm a 5-year-old kid. I'm trying to grow up. I mean, it's ridiculous. They cut the legs out of the bear case. Defaults weren't that bad. They sold loans on favorable terms. If you look back at, these tools like Chiavarini and that 5-head, they're telling you at the beginning of 2003 a doom and gloom scenario. By the end of 2023, SoFi is going to have their back against the wall. They're going to have to borrow money. They're going to be on the verge of bankruptcy. And what do you see? 180 degrees. And then these people come out and try to sell you the same line again. So I'm just not buying it. I think it's a bunch of crap, a fugazi to attack the stock. That's what I think. I think all these analysts are completely full of crap.
Yeah.
Not the bulls, the bears.
And this positive message of profitability is going to be amplified throughout the day on Bloomberg, CNBC, other outlets. Noto is doing the rounds. We're going to see analyst upgrades coming in from the same idiots that downgraded just last week. And so I think, it has the potential to start a strong momentum. We'll see what the stock does. I wouldn't be surprised if we sell off, honestly, but we'll see what happens.
Well, that's SoFi. I think the exciting part, and I didn't catch all the details about the loan sales, the capital ratios rose quite high from 14.5% to 15.3%. That's really, really exciting. So the biggest concern that I had whenever first seeing the numbers is that they expected lending revenue to go down on guidance. And I was thinking in my head, I go, this is exactly what happens whenever the capital ratio continues to decrease. This is what me and Chris argued about, was that brick wall that SoFi could run into. But they're seemingly selling a lot of loans. I think they said something along the lines of $1 billion worth of loan sales. I need to go back and check the numbers.
It was $1 billion plus. I think like 850 of them were unsecured personal loans. At
105.6% loan sale, I think it was what it was.
105.1, I think, is what I heard. But
okay. Yeah, that's what I mean. I need the transcript to get all those numbers. Once I have all that, I can break it all out. But I don't want to speculate on what I thought I heard. But yeah, very, very exciting. That means that if there is demand, they can fill it. There's a couple banking things that they got into, like, buying credit default swaps on student loans that ends up lowering their capital ratios. Well, actually, sorry, improving it. That, I'd like the opinions of like an IP banking research on, like, is this, because I'm just not that into the banking side of things rather than just looking at SoFi as a whole. So yeah, it'll be a little bit, but I've got 3 months to break out all these numbers and figure things out before the next time. So we're going to learn things continuously as this goes on. And so in SoFi management, good fashion, there's no 10K, so we don't get to see a lot of the numbers. But from what they said, a lot of the back end stuff actually probably looks better than the front end member and product growths that a lot of the retail audience likes looking at, versus what we're actually selling our loans at and what our capital ratios are at, which is seemingly the better part of this quarter, which is good. You want your
investors are a bunch
quarter,
of
right?
dummies.
Sorry?
Retail investors are a bunch of dummies. They're always trading in and out, and they overreact to everything.
I saw somebody in the chat saying that they sold all their shares now or something. I wouldn't do that.
No, hold.
I mean, do what's right for you. If you need that money, But
yeah, of course. I don't listen to me. Everyone knows that. Who knows me? It's probably go oppie, if anything, go opposite field on my regs.
Ladies and gentlemen, any last comments on this earnings call?
Man, it's really exciting. I loved the 2023, 2026 notes, and then beyond 2026 in the 8K. Pardon?
Yeah, that was huge. He didn't need to necessarily do that. that was just a cherry on top. 20 to 25% compound revenue growth assumes 50% compound revenue growth for financial services throughout that time. Like, I'm going to be nitpicking those remarks when we get the transcript, because he basically laid out the roadmap in terms of, how they're going to grow in products, what they're not really looking at right now for expansion, and in terms of the actual percentage growth throughout that entire time period. Like, read between the lines, guys. It's all right there. And I feel like that portion specifically was just meant for, like people like us, for example, who like look at the numbers and go thread by thread in terms of that transcript, because it's all there. It's all there. All you need to do is read it.
Yeah, we have a great company right now, and this is not a company that's done innovating. It's not a company that's done growing. They have a very detailed plan. This is not just a fly by the seat of your pants company. It hasn't been this whole time. Man, they're conservative, but the guidance they gave through 2026 and beyond is not conservative, and they might be sandbagging. So I'm very excited. This is a great time to be a SoFi shareholder. Even if we sell off as expected to, I think we'll go up some and we'll come back down, whatever, it's a stock price. Man, the company is awesome.
Ladies and gentlemen, thank you guys all for coming out and watching the show. I do personally have a FinTech Frenzy live stream tonight at 8:30. We're going to be breaking down all of the numbers a little bit further. So if you guys haven't seen that or are looking forward to see that, make sure that you guys subscribe down below to both myself or Tevis's channel, depending on who you're on. But obviously, you're not going to get FinTech Frenzy from Tevis. But
my channel, you get nothing. Horrible. Don't subscribe to my channel.
You want to promote your Seeking Alpha while you're at it?
No, I think that the course members will look at my chapter 7, the future opportunities, and see what Noto said throughout 2026 and think that I'm 100% exactly what he said was what my expectations were. So,
Danny,
as that goes,
Danny, will you be available on Friday for our episode of Roy Weekly?
I'm generally available. I like the way Roy is handling the newfound celebrity, and I think the fact that he's staying humble and he's still willing to even appear with us
seriously
is a testament to his character. So yeah, I mean, I'll make myself available if Roy's going to be here. Sure.
You guys are too much.
Roy, hopefully you'll bless us with your presence, my friend. It was so weird. Yesterday, Steve was just sending these like Chuck Norris-esque jokes that he's replacing Roy's name with, but like every 3 or 4 hours or so, like, I don't know, it's so weird.
Bro, you know that Noto got a pep talk from Roy last night. That's why he was so fired up in the call today.
Noto had a swagger in his voice, a little bit of a different tone. I think everybody heard that, even maybe Lapointe. I mean, there was just a little bit more confidence, and seemed like he was talking directly to the detractors, like point by point, and he was getting a little bit more confident and a little bit more cocky as he went. And I just love to hear it, because the performance, he deserves to be confident, and management deserves an attaboy. I think they're doing a tremendous job. So I loved it.
Yeah,
all right.
Yeah, we get to see him a couple more times today. So exciting day.
Yeah.
Can't wait.
I'll see all the audience members later, 8:30 p.m. Eastern Standard Time, and I'll see all you guys later on Friday, 10 p.m.
Thanks everybody for watching.
Have a great day, everybody. Thank you.
See you guys.